Welcome to TCM and our 7th video in our Green Day series. Let's talk again about short trades, and we have the list of Friday's weak stocks that basically fit our strategy, which is 5 million shares traded at least per day, price above $15, range percentage over 5%, and according to the price change, KBR is the worst performing stock out of thousands, of course, that were traded. And obviously we're gonna get into analyzing KBR. Now, for those who don't know, and I don't know myself, I had to go to Yahoo Finance and read who is KBR, what kind of company is. It's not a high-tech company. It's in the engineering, technology, and scientific solutions, providing governments with solution and commercial to governments and commercial customers worldwide. So basically, it's in the range. It trades as a technology company, but it's not really a technology company. Basically, I don't know if I can attach these stocks to a sector, and let's talk about it as standalone, because even in previous analysis that we didn't go and immediately attach the stock to a sector, because the sectors are so very much dominated by the big names, and this is clearly not a big name. Okay, so what happened in KBR Friday that was worth this 7% move lower? There was an announcement. It says announcement on Home Safe Alliance Global Household Contracts, Goods Contract, and again there wasn't that much info, being that again it's not a company that's in the headlines. I don't know how many journalists are covering it or analysts are covering it. Basically, if I'm going back to Yahoo Finance, there were a couple of headlines that were basically by Zacks. 5 days ago they asked why KBR is a top value stock for the long term. 4 days ago they asked are you a growth investor, and this one stock could be the perfect fix. So maybe the timing is not perfect for them, but again, it's none of our business. Those are long-term analysis. So something happened. Let's take a look at the intraday chart and see how, as a day trader, you can or cannot take advantage of this 7% move. Okay, and here we are. Let me align it up. Okay, so clearly there was a gap down and a move in the first minutes that's kind of spooky investors. The stock closed nearly at 53 on Wednesday. Remember, Thursday was a day off, and then in the first bar you can see a huge bar down in the first minute that its range was basically covering the whole day. So if we're looking, this is weird, but it happens from time to time when the bar was let me see how big the volume was. 250,000 shares traded basically in the first bar, and the range was 51 at the highs and 48.25 at the lows. Well, I don't know why it's not pointed here, but never mind. So we have 51 at the highs. You can see it clearly now on the chart, and let me actually price tag. Let's do it this way. 51 at the highs, 48.25 at the lows, and now we have to deal with the consequences. So as a trader, let me add the view up as well. As a trader, obviously you can see that this stock is already in a gainers losers list, obviously in the losers list, at one point down more than 7%. Then it was up a couple of percentage points, and let's see where can you trade it. As always, we go straight to the round numbers. So let's take a look at which is clear. 50. It doesn't get rounder than 50, and let's take a look at this setup. Again, I'm picking the wrong line, sorry about that. This is 50, and this is the triangle, potential triangle breakdown, and the risk. Okay, what is the risk here? Let's analyze them together. If the entry is at 50, the consolidation is above a 50-25, let's say 50-30. Worst case scenario 50-50. So it definitely fits the style that we love. A trend, a downtrend, a weak stock, a round number entry, less than 1% of risk. So all parameters are lining up for this stock. So 50 is the round number, perfect. Less than 1% of risk, perfect. A stock that's weak on the day, perfect. And the daily is not that important, but it's obviously not a strong stock on the daily chart. It's not like it is at all-time highs or anything like that. So let's see how we approach. So entry at 50, stop loss at I will make it 50-30. That's the trade. Short at 50, stop loss 50-30. So we have 0.5%. A little bit more than 0.5% of risk. So on 1,000 shares short, the risk is $300. Sorry, on a hold on. Let me go back to basics. On a $100,000 position, that's 2,000 shares. That's $600 of risk. On a 10,000 position, that's 200 shares, that's $60 worth of risk. So that's pretty much the strategy. Anywhere in between it can fit. Now, if we're looking at the volumes, when it broke down, the volume was, let me see, only 13,000 shares. So the liquidity is not that great. But it still can fit a strategy of, I don't know, $20,000-$30,000 per position. That's 600 shares. Again, it's hard to replicate that now because obviously I know that not many of us, if any, were looking at KBR, although it was positioned well high in the losing column. So what's the strategy here? Okay, so the entry is 50. Take a look at the amazing movement here. So the stock drops 40 cents, comes back again and again retests this level. We haven't seen this many times, but it happens. Okay. So what happens here, and this is one important lesson to learn from this price action. A stock breaks an important level, comes back, retests the level. Now, if you move the stop loss in the money, meaning under 50, you're exiting the trade, and then you're losing, unless you re-enter again, you're losing the real move. That's why the stop loss should be above, okay? 2 cents above, 3 cents above. So if your entry is 50, put your stop loss as 50.02 or 50.03. So worst case scenario, you lose 3 cents. You're not going to lose the full scale of the trade if you move the stop loss to the end. Just don't move the stop loss in the money. Now, if you trade according to our original advice, you need to know that we move the stop loss to the entry only after the stock traveled 1%. In this case, 50 cents, it traveled only 40 cents. I know that most of us, including me, are always eager when we trade to move the stop loss to the entry and forget about losing. This is a challenge because the stock traveled 40 cents, comes back to the entry. So if you make a mistake here, you move the stop loss in the money, you're out of the trade. Okay, so but if it was 50.02 or 50.03, I'm guessing, I mean 99.9% that you are in the trade and can continue with the trade lower, and eventually after moving sideways up and down, nothing aggressive here, it closes the day. So the closing day strategy works again, and you're getting $1 on the 30-cent risk. That's 3-to-1, which is amazing. So the close, is 48.93. Okay, it's actually posted on the chart. So 48.93, $1, the 30-cent risk fits perfectly the strategy. With this trade, everything is aligned. Now, are there additional points where you can enter this trade? Maybe there are, maybe there aren't. I see one at least, okay? But again, we don't want to take this analysis into adding points, taking partials, because it's an endless discussion, and then people, some lose interest, others think it's too much, and we want to go straight forward. So you start with your original position that fits your strategy, whether it is $5,000 or $50,000 or $100,000. Let's say that's why we're talking about on average $20,000 position. In this case, it's 400 shares. So 400 shares, it's $400. So that's the deal with this stock using a $20,000 position. And it can be easily leveraged up to 2-3 times, maybe 4 times as much. I won't exaggerate and say that you can enter this trade with 5,000 shares. It's not that kind of stock, and maybe it had some spreads that we're not discussing right now. I don't know how KBR normally trades. Obviously, it's not as tight as a top-tier stock. Okay, guys, I hope it was illuminating. You can see that using a very, very simple searching strategy and focusing on the worst of the worst to short and the best of the best to buy gives you an edge. Then you look for the right entry points, and on those entry points you look for entries which fit another part of the strategy, which is risk no more than 1% of your position. No matter how big the position is, assuming you're not gonna exaggerate. So if your position is $5,000 to $10,000 or $50,000 to $100,000 or even more, you will get probably the same results, assuming the stock is not very, very spready. So that's why we're moving and looking only at stocks that trade more than 5 million shares per day. We're not going to look at the stock that trades 20,000 shares per day or 50,000 or whatever. So that's part of the overall strategy. And again, the idea here is to reach 2 to 1 on your position, 3 to 1, and sometimes you will reach 10 to 1. Your worst case scenario is going to be 1 to 1. You're going to lose your 1%. That's the worst case scenario, unless something, I don't know, out of the blue happens and you're hitting an intraday news and the stock spikes against you. This is something that can happen maybe once a year, and you must be very, very unlucky for that. Okay, guys, hope it was enough for this, and plenty of people keep asking why is this strategy the one that we observe. Here's an explanation. Simple, to the point, and repeatable and scalable. Thank you, and we'll see you in the next video. Please share this video with your day trading friends.